Consumer Price Index or CPI report released on Tuesday reflected an 8.3% increase over last year and a 0.1% increase over the prior month. Economists had expected prices to rise 8.1% over last year and fall 0.1% over last month, according to estimates from Bloomberg. Since the inflation came in higher than expected in August, investors' bets that the Fed would move aggressively when policymakers meet next week solidified. Hence the market plunge. The S&P 500 were down 4.3%, Nasdaq were down 5.4%, and Dow Jones Industrial Average were down 3.9% by the end of the session. Some investors even starting to price in the possibility that the Fed could raise rates by a full percentage point, which would be its largest rate increase since 1984. The CME FedWatch tool showed a 18% probability of a rate increase of 100 basis points at the September 20th to 21st meeting. The probability was totally zero before CPI report came out. There is no doubt that trading for the next few months will be more difficult than before. Stubborn inflation pressures are likely to force the Fed to turn up the heat on its tightening campaign, which puts the broader economy at further risk of a recession within the next year. Clearly, we still remain in the bear market, and apparently this bear market has more to go. So, today I'm going to share about what should we avoid in the bear market and how to survive through this period. Making investment decision based on stock price is one of the common mistakes investors will do, especially when the stock market drop. For example, some investors will consider cutting losses or dollar cost averaging their equities only after their holding stocks have lost a specific amount. Instead of focusing on the share price, they should base their financing decisions on the company or the macroeconomy. Normally, investors who make their choices based on stock prices won't have any impact to their portfolio on the bull market. However, this way of thinking will cost you more than you might expect in a bear market. This thinking will grow stronger when the share price declines significantly, leading the investor to make the incorrect decision. This type of attitude is known as the anchoring effect. The anchoring effect is a cognitive bias that describes the common human tendency to rely too heavily on the first piece of information offered when making decisions. In other words, investors may buy or sell the stock based on historical data such as share price few days or weeks ago, the all-time high price, or even the stock price when buy-in. To evaluate whether a stock is worth investing in, we should look at their fundamental or the ability to bring you profit in future, and not to look at their share price before or your previous buying price. The only way to fix this mistake is we have to find out what is the reason that caused the share price dropped. Basically, we can separate the reason of stock price drop into two categories. One is fundamental driven, and the other is sentiment driven. To analyze the decline of share price is belong to which type, we can simply observe the cash flow of the company. If the reason that caused the share price decline will affect the future cash flow of the company, such as Luckin Coffee accounting fraud, then it is a fundamental driven decline. On the contrary, if the reason that caused share price dropped will no affect the cash flow of the company in future, then it is commonly just market sentiment that triggers panic sell. A perfect example would be Tesla CEO Elon Musk's tweet that the company's stock price is going to be too high in 2020. Tesla's stock price fell 10% on the day. The message had no impact on Tesla's future cash flow, therefore it immediately recovered on the following day. So, what should we do after knowing the reason that caused the drop of share price? If the drop of share price is because of the fundamental, then you must understand that the share price might not rise even if your portfolio suffered losses. In fact, when the fundamental on company become bad, the valuation of the company will drop, along with the share price also. And if you still holdings the stock at the time, you may want to consider allocate some of the money to other stock. However, if you are holding cash and intend to buy in, don't rush to buy in immediately because commonly market needs some time to digest the bad news and will need some time to rebound. But if the drop of share price is second type and you happen to have cash and plan to buy in, This will be a good opportunity for you. However, if you holding the stock, just remember one thing: don't panic sell. Yes, volatility is scary, but it can also be beneficial to your long-term success. Of course, sometimes the reason that caused stock price drop was not simply one type, but combined both factors. This will need investors to analyze themselves. The next mistake that investors often make was not manage the risk. For example, when a bear market starts, some investors prefer to keep buying the stock. When the share price drops once again, the investor purchases once more. They keep trying to buy at the bottom, but the stock price just keep dropping. They just won't cut losses on the growth stock and convert it to the value stock, despite the fact that value stocks often perform better than growth stocks during bear markets. The same things also happen in bull market. When the stock market is rising, investors seek to invest all of their funds in just one stock. They didn't diversify or even hedge their investments as a protective measure. This type of mentality can be explained by loss aversion. The concept of loss aversion in behavioral economics describes a phenomenon in which people consider a real or potential loss to be psychologically or emotionally worse than a corresponding gain. For instance, the joy of finding $100 is frequently far surpassed by the pain of losing it. This will cause investors make wrong decision because they can't afford the losses even when they knew the decision was bad. For example, when the bear market began, investors still buying growth stocks because they afraid might miss the last rally of the market. Even they are aware that growth stocks will not perform better than value stock in near term, they still won't do the right decision and hold out hope that the growth stock will increase one more time before they sell it. Here is how I handle loss aversion. We should never afraid when doing the right decision, because it will hurts far more if you doing nothing. What if the stock price rebound after I sell it? This is the attitude we should avoid. We should focus on the fundamental of company. Just like Warren Buffett said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. The last mistake investors will make in bear market is not having cash on hand. You don't want to be left with no choice but to liquidate your investments in order to cover your living needs if an unexpected bear market suddenly rears its ugly head. That's why it's essential to keep some cash in an emergency fund, such as a savings account. An emergency fund can save you from having to sell investments at a loss in order to pay your payments during a bear market or to cover an unplanned need like replacing your furnace or paying for a car repair. It will be more difficult to recover if you sell equities at the bottom of a market cycle, since you will have less money involved in the ultimate stock market recovery. To prevent taking money out of your assets at the wrong time, it's a good idea to have at least 3 to 6 months' worth of living expenses saved up in your emergency fund. Keep in mind that our goal is to stay in the stock market as long as we can, not to give up because we lost all of our money. If you have other opinions, let's comment below. Please help to like and subscribe.